Hello and welcome to the Business Standard Morning Show. I'm Binu Sandhu. Let's take a look at the stories for the day.
This is GE Vernova, helping generate and move the energy that will change the world. Welcome to a new era of energy.
The Indian banking sector has reasons to cheer. Commercial banks have clocked a combined profit of almost 60,000 crore rupees in the second quarter of this financial year. This was a 59% jump from the year-ago period, and it was also the highest profit recorded by Indian banks in any quarter. There is clearly optimism surrounding this sector. But what are the reasons for this, and are there headwinds ahead? Our next report has the answers.
Both state-owned and private lenders put up a strong show in the July-September quarter. 12 public sector banks reported an average of 50% year-on-year growth in net profit at 25,685 crore rupees. The jump came primarily on the back of a steady rise in net interest income and lower provisions. The second quarter results posted by PSBs were also supported by strong credit growth and expansion of net interest margins. Experts say while a moderation in net interest margins may occur going forward, healthy profitability is likely to continue. Asset quality also improved. At the end of September, state-owned lenders saw their gross non-performing assets decline 15.8% year-on-year to 4.98 trillion rupees. Their net NPAs were also down 13% year-on-year to 1.28 trillion rupees. However, hardening yields have had an impact on treasury income on a year-on-year basis, and experts say the treasury performance may stay muted. Meanwhile, private lenders collectively clocked a profit of 33,165 crore rupees, which was around a 67% jump year-on-year. The profit figures soared on the back of higher net interest income and robust loan growth. There was also a lag on the part of the banks in passing off increased rates of interest to depositors while pushing the lending rates higher, following the increase in the repo rate by 190 basis points. This translated into an impressive growth in the margins of these lenders. Asset quality also improved significantly as both gross non-performing assets and net NPAs declined year-on-year. Staying broadly in line with the credit growth, most private banks saw double-digit growth in their portfolios. Against this backdrop, there is now a sense of optimism surrounding the Indian banking sector. Business Standard consulting editor Tamal Bandyopadhyay says there is definitely broad optimism around India's banking sector, and the most important contributing factor is the quality of assets. Having gone through pain after the asset quality review, the sector has come out clean. Bandyopadhyay adds that on the asset side, the balance sheets are looking pretty good. According to him, the recoveries and lower slippages are also adding to the optimism. Provisioning for bad assets, which had been eating away at the profits of lenders, has come down dramatically since the June quarter. For most banks, the provision coverage ratio is very high. Overall, the sector is quite healthy at present. Others are also sanguine about the sector.
We now realize that there is some kind of a, compared to the other global countries or the emerging countries, you find ourselves sort of in a better economic growth condition. This leads to two things. One is it leads to better recovery, it leads to optimism. And of course, according to the governor's last statement, there is a better capacity utilization as well. The second important factor is the quality of assets. The quality is improved for the existing assets, as well as, I suppose, for the new assets which the banking sector is adding. The quality of, let's say, the credit or the assets is really improved a lot. The third is the digitalization of the digitization. A similar huge amount of challenge that was thrown up during the COVID. Indian banking sector faced it very well, be it private sector, be it public sector. Perhaps the last and the fourth one is emergence of a much stronger public sector banking also after the consolidation, after correcting the balance sheets.
There are areas of concern too. A State Bank of India research report has said that banks are not adequately pricing in credit risk, even as liquidity remains significantly downsized and credit demand is at decadal highs. Earlier this year, RBI Governor Shaktikanta Das had said that banks could not perennially rely on the central bank's money to support credit offtake, adding that they would have to mobilize their own funds and resources. The latest RBI data show that as on the 21st of October, bank credit growth was at almost 18% year-on-year, while deposit growth lagged far behind at below 10%. This raises questions about how sustainable this recovery will prove to be in the coming quarters.
Net interest margin will definitely have to come down, because as you have seen, the banks which have been, most banks, I would say, have been recording about 20% credit growth, which you yourself said is a decadal high, even for the industry, the entire industry. But where is the deposit growth? Deposit growth is half of it. Some of the banks is even 1/3 of credit growth. Now, to what extent you can support this credit growth? You have your capital, and then you can borrow short term, which they are through CPs and CDs, which many of the banks done. But at the end of the day, you need to raise your deposit rates. And once you raise your deposit rates, which most banks have been doing, but they have to raise it more. So certainly the NIM will be affected.
Bandyopadhyay also says that we need to be watchful of any irrational exuberance in the credit segment, adding that the underwriting has not been immaculate. According to him, there is a worry that certain state undertakings that probably believe that they are the proxy sovereign may be giving loans without the right kind of underwriting. Thus, he warns of the possibility of some banks ending up with higher NPA levels once again.
So there's a hard mentality which we had seen the last decade, and that led to Reserve Bank of India's massive cleanup dive in the form of asset quality review. Probably we may see this again, maybe 4 quarters, 6 quarters down the line. And as they say, when the tide goes out, who are swimming naked, you will find them. So some of the banks may have to pay the price.
It is clear that banks will have to aggressively raise their deposits in the days ahead and garner durable liquidity to meet the rising credit demand. At the same time, they must ensure that underwriting remains as credible as possible.
It is not just banking, India's aviation sector too is looking up. It is one of the fastest growing in the world. Recently, Prime Minister Narendra Modi said that India will soon be manufacturing large passenger aircraft. It seems that the country's aerospace industry could be on the cusp of a paradigm shift. So will the dream of a made in India passenger plane really take off? Let's find out.
Those subtle maneuvers before the abrupt halt, and then the sudden jolt and a burst of engine thrust. That feeling of being pushed into your seat as the aircraft accelerates down the runway, and then that sensation of weightlessness during the takeoffs. Taking to the skies is always exhilarating, and as you do so, you often find yourself wondering what it would be like to be in the cockpit. You marvel at the amazing feat of engineering that aircrafts are. Some of you may also ask, will we ever get to fly on a Made in India plane? Prime Minister Narendra Modi answered that question last month. He said India would soon be manufacturing large passenger aircraft. He added that they would also be marketed across the globe. The statement came at the foundation stone ceremony of a Tata Airbus manufacturing facility in Gujarat. The PM could have meant two things. We could convince foreign civilian aircraft makers to set up a final assembly line in India. It is an exclusive club. Airbus and Boeing form a virtual duopoly in the global market. The likes of Bombardier, Embraer and Tupolev make up the rest of the industry. Or we could design and build an Indian passenger plane from the ground up. The head of a major Indian aerospace company says that asking Airbus or Boeing to establish a final assembly line in India would be easy. A final assembly line is justified if it churns out at least 5 to 10 aircraft a month and there is an overall demand for about 120 a year. The industry expert says that level of consumption is possible between the airlines India has today, especially when the outlook for the coming decades is bullish. The Indian aviation market will need an estimated 2,200 new aircraft between 2022 and 2040, a threefold jump from the country's commercial fleet at present. That's just a shade below what all the Latin American airlines will need in that same period and about 65% of the entire Middle East region's projected demand. And while China will need almost 4 times as many new aircraft by 2040, Beijing's homegrown civil aircraft may prove to be a threat for Boeing and Airbus in that market. In the past, China also took this route. In 2008, Airbus inaugurated its first final assembly line outside Europe in Tianjin. A decade later, Boeing opened a completion and delivery center for its 737 family of jets in Zhoushan. But the industry expert from before cautions that a final assembly line will end up importing major components, as is the case for similar ventures elsewhere. He adds that it will create few jobs and lead to little value addition beyond what the Indian aerospace industry is already doing for global OEMs. For instance, Boeing sources $1 billion in products and services from India annually. While its network of over 300 Indian suppliers is growing, the company is also investing in a $200 million center of excellence in the country. Airbus says that every commercial aircraft built by it is partly designed and made in India. The company sources $650 million in manufactured parts and engineering services every year from over 45 Indian suppliers. Giving this ecosystem wings could go a long way towards building a truly Indian passenger plane. And Arvind Meligiri, the chairman and CEO of Equus, one of India's major aerospace manufacturers, has a roadmap in mind. Meligiri says that the government must ask Airbus and Boeing to significantly increase their sourcing from India. As a result, Indian suppliers will move up the value stream. According to Meligiri, this will ultimately enable India to not only assemble a complete aircraft for Airbus or Boeing, but also for itself.
We need to just ask a simple question to the OEMs. What percentage of their sales are in India and what percentage of their procurement is from India? That should be somewhere balanced there, which doesn't exist. If they can just bring close to that, we'll be so much prosperous with respect to aerospace industry in India.
Nonetheless, Meligiri cautions that it could still take 30 years for India to have its own large turbofan engine-powered passenger plane in the skies. Even Airbus and Boeing take over 10 years to execute a clean sheet program. However, the real hurdle in building a designed and made in India passenger plane will be the money needed. After being in development for over a decade, Beijing's first homegrown passenger jet, the C919, won Chinese regulatory approval in September. The narrow-body airliner is seen as a symbol of national pride. But one US think tank estimates that it has come at an astonishing cost. To smooth over the C919's development, the Commercial Aircraft Corporation of China may have received between $49 billion and $72 billion from the Chinese government between 2008 and 2020. In comparison, India will spend less than 3/5, $29 billion of the lower end of that amount on the production-linked incentive scheme in key areas over 5 years. However, India need not break the bank by following China's example. That is, if it can right-size its ambitions in line with its requirements. Meligiri explains that India is not a very large country from an air distance perspective. The duration of domestic air travel is mostly under 2 hours and point to point. Thus, according to Meligiri, the ideal aircraft for India to start with would be a turboprop.
A revolutionary way of looking at it is if there is a potential of a large turboprop aircraft which can be used, could be efficient for India potentially. Because the distances are very small.
If India's aim is a homegrown passenger plane that can compete with China's, then Rossel India Director Rishabh Gupta says that the participation of both a strong government entity and the private sector will be needed. Tie-ups with global OEMs may also prove necessary. Rossel Texas was the first Indian manufacturing company to win the Boeing Supplier of the Year award. It accomplished this feat twice in the past 5 years. Gupta adds that it will be a capital-intensive venture requiring grants, incentives, and subsidies from the government. He also suggests a review of the tax structure on raw materials, which are mostly imported at present, to encourage more local content. An Indian-designed and built passenger plane will be a mammoth undertaking with plenty of turbulence likely. But the industry insiders who spoke to Business Standard unanimously believe that India has to make a start sooner than later.
The September quarter corporate earnings season is near its end, and select pockets are firmly outshining the weak global outlook while others are lagging behind. So how did India Inc. fare in the second quarter of FY23? And what is the possible trajectory of the remaining 2 quarters of the fiscal year? Here's a roundup.
The July-September corporate results of FY23 are in their last leg as India Inc. moves past another quarter of uncertainty and high inflationary pressures. The earnings show for the recent quarter was a mixed bag, as per experts, though the results largely came in line with what the street had expected, they say.
So I think the earnings were pretty much in line with the estimates. But we also need to understand that the estimates were downgraded by about 3% for the Nifty before the earnings actually started. But the performance of heavyweights like Reliance, TCS, HDFC, Infosys, ICICI Bank, all these were actually pretty much in line. And almost like 70% of the stocks which have declared earnings so far, they have either met expectations or slightly exceeded the expectations.
Within sectors, analysts say global commodity-based industries were the biggest drags during the quarter. As per Motilal Oswal, the profits of 32 Nifty companies slipped 2% year-on-year, led by global cyclical industries such as metals and oil and gas. Excluding these, it estimates the profits grew 25% year-on-year, led by the BFSI pocket.
The highlight of Q2 results released so far is the excellent performance of the banking segment. Banks can continue to do well in the next 2 quarters of this financial year also, since there is impressive credit growth in the economy and interest rates are rising. Also, asset quality of all the banks have improved substantially. The second best performing segment has been automobiles. But in automobiles, the premium segment has done much better. The IT segment results are also in line with expectations. There are concerns regarding the slowdown in tech demand, triggered by a possible slowdown in the US next year. But the slowdown concerns have not yet materialized in the results. The disappointment has come from commodities, metals, oil and gas, and cement. But this was on expected lines. Better than expected performance has come from the pharmaceutical sector. And this has been made possible by some very good results from companies like Sun Pharma.
That said, in the broader market, earnings beats and misses have been evenly poised for the Nifty 200 index so far, according to analysts. For instance, as per ICICI Securities, around 20 earnings beats from the Nifty Midcap 100 index have firmly cushioned against 15 earnings misses from the Nifty Next 50 index. Besides, going forward, analysts expect FY23 Nifty earnings to be impacted due to continued rate hikes over the next few quarters.
Estimates are mostly not met in the case of Nifty. That has been the trend for almost now 5-6 years. The earnings growth, our estimation is that the Nifty profits will be a little lower because of the higher interest rates continuing even over the next at least 2 to 3 quarters. So even though profits might grow, the margins would be a little less in that sense. So the Nifty EPS, I think it's about 820 to 830 kind of a level.
Motilal Oswal also sees limited upside to the Nifty index in the near term, as it is now trading at around 22 times its FY23 earnings, 13% above the 10-year historical average. Markets will track global cues for direction today. The street will also react to Tuesday's Q2 results of Jubilant Food, Godrej Consumer and Bajaj Electricals, among others.
Can economies grow without disturbing the environment? Leaders of over 150 countries are currently camping in Sharm el-Sheikh, trying to find a way to achieve this delicate balance. The world is becoming warmer, and attempts are being made to keep it below 1.5 degrees Celsius by the end of the century. The outcome of the COP27 summit may well determine the future course of humanity. But what is COP27? Watch our next report to find out.
In June of 1992, Rio de Janeiro in Brazil hosted 117 heads of state and representatives from 178 countries. It was the largest recorded gathering of world leaders. The reason? To strike a balance between economic development and the environment. At that landmark United Nations Conference on Environment and Development, better known as the Earth Summit, 3 conventions were set up. One was on biodiversity, one on desertification, and one on climate change. Each of these conventions has a yearly conference of the parties, or COP, which sees signatory countries called parties meet to assess progress and figure out how to move forward collectively. The COP is the supreme decision-making body of the convention. COP27 is the 27th meeting on climate change. The first one was held in Berlin in 1995. The COP meets every year unless the parties decide otherwise. There are now 197 parties to the United Nations Framework Convention on Climate Change, all of whom have signed the Paris Agreement, the first global climate pact. Signed at COP21 in 2015, the Paris Agreement's goal is to limit global warming to well below 2 degrees, preferably to 1.5 degrees Celsius compared to pre-industrial levels. Delegates from the 197 nations and territories are meeting from November 6 through November 18 in Egypt, with the key aim of ensuring full implementation of the Paris Agreement. According to the UN's Intergovernmental Panel on Climate Change, CO2 emissions need to be cut 45% by 2030 to meet the central goal of the agreement. For the first time, COP27 has placed loss and damage finance on the agenda since climate talks began decades ago. Developing countries including India, small island nations, and several indigenous communities have been batting for a separate fund for loss and damage to tackle the extremes of climate caused by historic polluters. Examples include damage from cyclones or drought, or permanent damage from rising sea levels or the drying up of rivers. In UN climate talks, the phrase loss and damage refers to the costs already being incurred from climate-fueled weather extremes or impacts. At COP27, India is also calling on rich countries to live up to their promise of providing $100 billion in annual climate finance to developing nations.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
In 2009, developed countries, which are most responsible for global warming, had pledged to give $100 billion per year by 2020 to help developing nations deal with its consequences. But the actual contribution has been way below that. That's all for today. For more news and analysis, please log into our website www.business-standard.com. And we'll also be back tomorrow morning with more. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.